Look at the tape. S&P 500 earnings growth is running near 25%, yet individual stocks collapse even after reporting a profit beat. The macro data is just as contradictory. Headline inflation is cooling, but energy markets just saw oil prices jump nearly 4%. Most participants navigate this like the investor on the left, reacting to every push notification and trying to guess what happens next. The investor on the right uses a process, a defined dashboard of 4 gauges used to read the evidence. The core tension is that the market is strong but fragile. High earnings growth provides a solid engine, but record high valuations mean the leadership is cracking under the weight of massive expectations. To navigate a fragile boom, you have to stop trying to predict the future. You need a way to read the market's real-time evidence. Our first signal is earnings. The S&P 500's forward PE is 20.3, well above historical averages, leaving almost no margin for error. Here, a headline beat is meaningless. It's forward guidance that supports or crushes a stock's price. Our second signal is interest rates. Think of government yields as financial gravity, constantly pulling on the value of corporate cash flows. We track the 2-year yield at 4.18% and the 10-year yield at 4.55%. Yields aren't automatically bearish. The danger threshold is when yields rise faster than earnings expectations, a force that aggressively compresses stock valuations. Earnings are the engine, but interest rates determine the incline. Higher rates mean that engine has to work harder just to maintain current levels. Signal 3 is market breadth. Think of 10 people carrying a heavy object. It's a stable move. But if 8 people step away, leaving just 2 to carry the weight, the entire structure becomes vulnerable to a collapse. We are seeing this vulnerability now. While mega-cap tech stocks in the QQQ saw a 1.5% drop recently, small-cap companies in the IWM held much steadier. The index is being held up by fewer and fewer names. Our final signal is inflation. The Fed's freedom to support the market depends entirely on price stability. The components of the latest reports show that falling energy prices pulled the headline average down. But beneath that surface, import prices have surged 7.1% over the last year. Sticky underlying inflation acts like handcuffs on the Federal Reserve, preventing them from lowering rates to cushion the blow if economic growth begins to stall. Narrow breadth makes the index vulnerable to a shock in just a few stocks, and sticky inflation ensures there is no immediate safety net from the Fed. We can apply all 4 signals to the dominant trend in today's market, the artificial intelligence build-out. This boom stresses the earnings and rate signals. Big tech capital spending is projected to exceed $700 billion by 2026, much of it financed through massive debt at today's higher interest rates. It also impacts breadth and inflation. Leadership is currently concentrated in a handful of chip makers, while these massive data centers compete for the same electricity, for cooling capacity, and construction equipment as the rest of the economy. This framework measures whether AI revenue is arriving fast enough to justify the spending, or if the trend is evolving into an over-financed bubble. To turn this into a process, we map these signals into 4 regimes: constructive expansion, selective high rate, growth warning, and stagflationary risk-off. The rule to move between them is confirmation. Don't change posture on one headline. Wait for earnings, rates, and breadth to align. For the week ahead, use this checklist. Check if earnings guidance is rising, monitor if the 10-year yield stays near 4.55%, and watch if small caps continue to hold up better than tech. This evidence-based approach replaces the need for a prediction. Instead of reacting to the news, you are simply following a process. Here is the current dashboard. Earnings are a tentative green, but rates, breadth, and inflation are all signaling caution. Don't predict the market. Read it.